All of you with us. I am really looking forward to today's content as I do the first Wednesday of every month. We're going to hang out for just a minute or two to make sure that everyone can join and get settled in. Dan and I are coming to you from our office here in Bozeman, Montana. Dan, how is your corner of the office?
You know, it's quite warm in this room, but it's nice to be back in the office after doing this last one remotely last year. So it's nice to be back in the office. It's nice to be here.
Yeah, absolutely. We had our quarterly retreat last week, which is a big week. So I feel like we're still in recovery mode, but it's really fun to see you again today, Dan.
Yeah, nice to see you as well, Amy.
Yeah, absolutely. Perfect. Yeah, seeing lots of familiar names. Welcome, everyone. Hopping in the chat. So good to see you, Rich. We're going to let just a couple more people join. Welcome. All right, perfect. Well, it's a minute past the hour here, so I am just going to go ahead and get started. Hi, everyone. Thank you for joining us today. My name is Amy Arno, and I am a lead business development specialist on the XYPN sales team. Today, I am jazzed to host this webinar, Bookkeeping 101 for Independent Financial Advisors, with Director of XY Bean Counters, Dan Keslin. Dan is going to present for the next 30 to 40 minutes, then we'll open it up for questions. If you didn't have the opportunity to submit your question beforehand, please use the Q&A panel, which is the second down on the right from the chat, for anything that you would like us to address. Also, just a quick reminder that we do host these free webinars every month. So be sure to mark your calendar and join us on Wednesday, September 1st for Burnout, Boundaries, and Balance with XYPN Senior Director of Member Success, Maddie Roche. And you're just gonna look in the chat for a link to register for that. So that's all I've got for you. I'm gonna turn it over to Dan now. Dan, take it away.
All right. Hey, everyone. My name is Dan Keslin. As Amy mentioned, I'm the director of XY Bean Counters. And we are a service line of XYPN Network that helps you do your bookkeeping and accounting and outsource that function of your business. So let's go ahead and get started here. And as Amy mentioned, as I go through things, if you have questions, feel free to drop those in the chat and we can address them at the end in the Q&A here. All right. So we're going to get started out with a poll, actually. And really, without knowing what bookkeeping is and without me explaining what it is, how many of you have done bookkeeping before? So this poll should be available to you now here. We'll give it a minute here, minute or two. Doesn't look like I'm getting answers on here, so I wonder if this poll is happening. Oh, there we go. We'll wait for a few more votes to come in, but it looks like not really the majority, just around 54% of you have done bookkeeping before, 36% have never done bookkeeping before. All right, that's dropping a little bit as we have more are saying, I'm not sure if what I have done is technically bookkeeping. All right, we'll give it another couple seconds here, get a few more votes in. All right, the tables have turned now. We have the majority of people have never done bookkeeping before, and only 44% of you have actually done bookkeeping. Well, 14% of you are not sure if what you have done is technically called bookkeeping. I'm going to go ahead and close this poll, so thanks for answering that. But what we'll get into now, all right, is talking a little bit about bookkeeping and what it is. Really what bookkeeping is a method to record all business transactions and translate that into usable reports. It's maintaining those records, making sure that all the data that goes through your business for business transactional data is in a financial statement. A lot of it is data entry, a lot of it is recording payroll, creating invoices, making payments. So bookkeeping can really encompass all of that. What is not bookkeeping is really looking at that data and analyzing it to produce forecasts or budgets or projections on that. That's more falling on the CFO side. which is not really what the focus of our webinar will be on today. Next slide here is then, why do you need to maintain your books? A big part of why you need to maintain your books is compliance. All state and SEC regulations that we have looked at say that you need to maintain accurate books and records. Whether it's maintaining client records, invoices, engagements, or financials, you're responsible for doing it and being able to provide those records when they request them. Regulators could request 3 years of prior statements in a regulatory audit. They could request looking at all the invoices that you've notified clients for charging them for their fees, and really just maintaining all that in your books is important so that you have that information available to send to them at any point in time. Another big reason here is tax purposes. When it comes time to file your taxes, having accurate records readily available makes filing those taxes easy. If you don't have those readily available, you're gonna have to send your CPA statements, you're gonna have to send them receipts and really get them a bunch of information that you could have had all in one system if you just maintain it throughout the whole year. What that will also translate to a tax purpose is money savings. If you give your CPA and a profit and loss, or better yet, give them access to your QuickBooks file by adding them as an accounting firm, your tax prep will be easier for them. In theory, that should cost you less money. If you give them bank statements in an Excel file or a box of receipts, and yes, we have seen this before when we've done taxes here, you will be paying the CPA at $200 to $300 an hour to basically recreate your books, which you could have done in the first place or outsourced in the first place. The other part of it here is time savings. If taxes need to be filed timely, for example, you have a deadline where you have to get them done by the 15th, and say you look at it on the 10th and you're like, oh my gosh, I have to get my taxes done. Having up-to-date books will allow you to perform that tax preparation more in time. Another big part of why you do bookkeeping here is to analyze your business performance. How do you know how well you are doing without really having a system to look at or reports to look at? Granted, you probably know how much money is in the bank, and that's a really big parameter, a good thing to know about your business. But what about your gross profit margin? How much do you spend on marketing and lead generation each month for the last 6 months or the last 6 years? So these are details that when you maintain your books, you can actually look back at that performance and see how much you've spent, how much that spend has changed over time and trends toward that. Say, for example, you want to be spending 30% of your gross revenue on marketing and lead generation. With bookkeeping and within QuickBooks, you can dig into those details to figure that out if you are meeting that goal. Last part here is debt funding. This isn't necessarily related to your business, although it can be, but the example I'm going to give is if you need to get a mortgage. You tell the bank that you're self-employed, you have your own RIA, and you do financial planning. I guarantee you that they will want to see a year-to-date profit and loss and balance sheet for that business. Being able to get that to them quickly is paramount, because this is when you're going for a mortgage, it's very time sensitive. They're going to want to see that profit and loss or the income statement just to verify that what you're showing as your monthly income matches to what you're reporting on those systems. Really having an accounting system set up and up to date and maintaining your bookkeeping will allow you to easily pull those necessary reports and not delay the financing process. All right. We have another poll here that I'm going to make visible right now. So does your state require cash or accrual-based financial statements? So you would probably know this if you've gone through the initial registration process, or if you've had a regulatory audit and they've said you need to change how you're doing things. So of what you know about this, does your state require cash or accrual-based financial statements? Go ahead and vote, please. All right, one vote in that says I am not sure. That is a good answer. We'll give it a little bit longer here to get a few more votes in. All right. Looks like the majority, so 70% of the 10 votes, 7 of you are not sure what your state requires. That may be because you haven't gone through the initial registration process yet, or you haven't really started that process, and that's totally fine. For those that do have their RIA set up already, you probably should know what your state requires. It looks like 8% of you have accrual-based, 16% cash-based, and 76%. So overwhelmingly not sure what your state requires. All right, I'm going to go ahead and close this vote here, or close this poll. Thanks for taking the time to do that. And really why we were asking that is because if you don't know that, that is something that we do know, and we have a lot of resources on that. The compliance team has a lot of resources on that. But when preparing your books, you need to know whether or not you need to be working on a cash basis or an accrual base for those books. I'll talk more about cash and accrual here in a little bit, so don't worry if you don't understand what I'm talking about there. All right, implementing an accounting system. So here at XYPN Counters, we exclusively use QuickBooks Online, which is that one that's started up top here. QuickBooks Online is a system that we found to be the most powerful, efficient, it's relatively affordable, and the reporting from what we think is really great. The connectivity to the banks is the best we have seen in any of the online accounting systems as well. So it really allows for real-time data connecting to any obscure banks, including these random ones that we've never heard of and credit unions. And it's really good at keeping that data clean and efficient. So why online instead of the desktop version? Many of you will look and see that the desktop version is like $90 and it lasts for the entire life, paying $50 or $30 a month for this online version. The simplicity of use with an online system is really the main reason why you want to pay for that difference. If you have the desktop version, you have to send a backup copy or an accountant's version copy to your CPA, your bookkeeper, every time changes need to be made. Then they have to send it back to you so you can pull those reports and log in and look at it. Really, it's just inefficient. It's worth spending that little bit of extra money to have everything in real time. With online, including Zero Wave, FreshBooks, and QuickBooks Online, you can be in there pulling reports and reviewing financials, and your CPA or your bookkeeper can be in there recording data or reviewing what you're looking at as well. It's really nice to be able to like simultaneously work on that project or work together to figure out what's going on rather than sending files back and forth. We don't recommend you use QuickBooks Desktop. All right, so the other systems that we have on here are Zero, Wave, and FreshBooks. And they do work. A lot of advisors use them. It's not a system that we have decided to invest into and learn and really work with. We decided we want to be the experts in one system, so that's not really one we have a lot of experience with. But we do know that they connect to your bank, they can generate reports, but they're not the most efficient system at reporting, and they don't have a lot of the functionality built in to save you time, like rules and splitting transactions that we will talk about here in the tips and tricks section in a minute. So why not Excel? Excel is a static system, so it's not really pulling in transactions, it's not really automating reports, it's not really generating anything. Everything you put in Excel is data that you pulled in and put in there manually or imported into it. So it's more difficult to do double entry accounting, meaning that you don't have a debit and a credit for every one transaction. Reconciliations can't be done within Excel, that's really difficult to do. Really, the online systems save a lot of time when you go to do those reconciliations because they have that functionality built in. And reconciliations are just verifying that what shows up on that balance sheet doesn't have duplicate transactions, there's no missed transactions, and it matches the bank statement as of the end of the month or that given date. I forgot to mention here, I'll go back real quick. XYPN members, make sure to ask about the discounted QuickBooks Online subscription. We, as an accounting firm, a bookkeeping firm, can offer that to you as our members. So as you are part of the network, that is a benefit that you can get. All right, now we're going to talk about setting up your books correctly. If this is something that you want to do yourself, that's great. It's not too difficult to do, but if you have no accounting experience or really understanding of accounting in general, this may be a little bit difficult, and we do offer a setup and training service. So you can not only get your books set up, but we can train you how to do your bookkeeping. So that's the quick tip. Work with us to get your chart of accounts set up and get trained on how to do it. All right, so setting up your books correctly. You wanna make sure that you link your bank and credit card accounts. Only business accounts should be connected though. So you don't wanna have personal accounts that you have a random business expense in here and there. You don't wanna have those connected because QuickBooks is going to pull in every transaction from that account. It's gonna pull in your gym membership, you're going out to dinner with your wife or whatever you're gonna have in that personal account. So we just wanna make sure that business accounts only are connected. You want to link all those business accounts in QuickBooks. Really the point is that QuickBooks is going to pull those transactions in for you, so you do not have to manually enter that data. You don't have to go line by line off the statement and put it in the register. QuickBooks is going to do it for you. All you have to do is tell QuickBooks where to put it. You can link checking accounts, credit card accounts. The downside with what we've seen a lot in this industry is you cannot connect your sundry accounts at TD Ameritrade or Schwab into QuickBooks. That is still manual data entry. We need to record that income when it hits those accounts, not just when it's transferred to your checking account. So that's something that QuickBooks is aware of, and hopefully they're going to build that functionality in soon. But we haven't seen any bank system that really connects with those TD Ameritrade sundry accounts very well. Next part here, opening balances. So if you have an existing entity and you're just getting into an accounting system, but you've been in existence for a year or two, say you have prior period tax returns or prior year tax returns. Basically, you want to take all those values that you put on that tax return and put it into the end of the year for the prior year in that QuickBooks software. That will put the balances from the prior year into retained earnings. So when you go forward in the next year, all those balances beginning will be correct. If you have existing accounts going into a new system, but you haven't been in existence for a year. So say, for example, you decide to set up QuickBooks Online in October, but you've been in existence since January and you just haven't really done any bookkeeping yet. When you connect those accounts in QuickBooks or any of the accounting softwares, it may only pull the prior 6 months or 3 months or 8 months of data in there. So it could be missing a few prior period months. Basically, any of those opening balances that the accounts had when you connect that are going to go to this account called opening balance equity on the balance sheet. It's in the equity section, which we're going to talk about here shortly. But you want to make sure that those are tied out and reconciled, that opening balance equity account, so that it is appropriately applying the deductions and all the transactions that you need are actually getting pulled into the system. All right, adding business expenses paid through non-business accounts. So most often we see this happening when advisors are just starting out launching their new business. They've decided they want to break away and start their own RIA, but to get started, they're paying for their XYPN dues and membership fees out of their personal account. So how do you get those on the books so that you can deduct those are deductible business expenses? That is so basically, when you're getting your business started out and you're paying for any expenses personally or any business expenses out of personal accounts, you want to make sure that you track those, whether it's in Excel or on a piece of paper. Just get those written down. You want to have the date that it was incurred, who you paid, what the amount was that you paid, and what the purpose was. So for XYPN dues, you would say August 1st, 2021, $447. XYPN is the vendor, and it's for membership dues. That way we can get those on the books during the setup process when you're setting up your books as an owner contribution. This will increase your equity in the business, and it will also increase the deductible expense that shows up on your profit and loss for that membership due expense. All right, chart of accounts here. We have a chart of accounts template on our website actually as a freebie to you all. You just have to go and download it and start using it. But you can import this directly into QuickBooks, and it's been tailored specifically to this industry. So it's something that we recommend you use, and basically it's built simply enough that it's easy to translate into a tax return so you can do your own taxes, and it has the appropriate accounts for your industry. There are some nuances and sort of adjustments that may need to be made because of your business entity type, whether you're a single member LLC, a sole proprietor, a S Corp, or a multi-member LLC. There are different nuances there with the equity section. That is something that we can help you get figured out as well. But the basic chart of accounts template that we have in there is a great place to start. All right, next poll here. For those that have started their business, what entity type did you choose, or what entity type do you intend to choose when setting up your business? So this poll should be visible to you all now. Go ahead and vote, please. No votes so far. Come on, people. Get the participation there. All right, 4 votes. Perfect. Thank you. All right, we've got 16 votes. We'll give it another 30 seconds here so to give a few more people a chance to chime in. I'm very surprised to see that there are no votes for other/not sure. I was expecting you to not be sure yet if you hadn't launched it yet. So that's good that you all know about what you're gonna do. Overwhelmingly, like we expected, LLC is the leader here at 64%. So of the 37 of you that have voted, 24 voted for LLC, and that's single member LLC, limited liability corporation. All right, I'm gonna go ahead and close this poll. Thank you again for participating there. So as a single member LLC, and the reason why we asked this poll is because when you're setting up your books, that equity section is going to be a little bit different depending on which type of entity you are. For example, if you're an S Corp, you're a shareholder, you have to pay yourself a salary. So you'll have owner's salary and owner's health insurance and those types of things. Whereas a single member LLC, you can just have member equity, member distributions, member contributions. It's a little bit more simple to set up. All right, now that we've talked a little bit about bookkeeping setup, let's talk about accounting. So accounting 101 basically is some insight into what accounting is and what you need to really, the basics of accounting to set you up for success when doing your own bookkeeping. All right, so we're going to talk about assets, liabilities, equity, income, and expenses. So what are assets, liabilities, and equity? Assets are any investment type assets or anything that the business owns. Say, for example, furniture, a building. Those are all asset type accounts, and those are sort of going to be in the top half of your balance sheet. Liabilities and equity, or let's start with liabilities, excuse me. Liabilities are like credit card balances or any loans that you have on the business. Say, for example, you got a loan from a bank to buy out another book of business that you are bringing into your business. That book of business will be an asset, but there's also a liability for that loan portion that you took to be able to buy that asset from another advisor. PPP loans, EIDL loans, well, PPP loans until they're forgiven should show up on the liability section as well. There's current liabilities, long-term liabilities, and all those options are available for you to choose from within QuickBooks. Equity is really what's going to show your ownership percentage or your amount of equity in the business. So you can have multiple members in that equity section. You can have just your LLC, but it's going to show the net amount. So of all the contributions and distributions that you've put into and taken out of the business respectively, and the prior period earnings, what is the total equity that you have in that business? Income and expenses are profit and loss, so income statement type accounts. Income, you all know, that's the amount of money generated, revenue, financial planning fees, investment management fees, consulting fees. Those are all income type transactions. Expenses, those are all anything from cost of goods sold. So anything you're paying for a sub-advisor or dues and memberships or meals out with clients, those are all expenses that are going to ultimately translate into your net income on that profit and loss statement. So basic definitions there of what those are. Next here, we have the accounting equation. So many of you are probably going to be going through your initial registration, maybe with our compliance department, maybe not, but you have to, many states require you submit a initial balance sheet with that initial registration. Oftentimes we review those and the assets do not equal liabilities and equity. This is very important because this is the accounting equation. And if a regulator or an auditor sees that your assets do not equal your liabilities and equity, I guarantee they're going to send it back to you and tell you to fix it. So when you are preparing that initial balance sheet, just remember the simple equation. Everything in total assets has to equal your total liabilities plus your total equity. If it does not, there's something missing, you've got to fix it. All right, this is a little bit of a chart here that's showing the effect of debits and credits. So debits in Accounting 101 are basically, think of it as a plus. Credits are a minus. So when you debit an expense account, it increases the expense. So it's increasing the deductible expense on that business. When you debit an asset, that's as if you deposit money into a checking account or an investment account. It's increasing that asset. Credits increase income, credits increase liability, and credits increase equity. So you basically, when things are going the wrong way in a double entry accounting system, think about what a debit and a credit do. And you may just have to switch it to make it go the correct way that you want to do. That's getting a little bit more into higher level accounting, maybe not one-on-one functionality there, but think about this chart and you can reference this this slide when you're doing your own accounting and things don't add up correctly. All right. Next slide here. All right, fundamentals of accounting. Fundamentals of bookkeeping. I keep saying fundamentals of accounting because that was my first accounting course I took in college. But all right, step one here. Categorize transactions from the bank feed. So before I get into this, actually, this is a process that we have built at XYPN Counters really to So every bookkeeper can follow the process, as well as we can tell you all what you really should be doing for that bookkeeping function and the fundamentals of bookkeeping. This is our process. There may be other better ways out there to do it, but this really works well for us in this industry that we're in. So really what we do first and what we recommend you do first is go directly to that banking section within QuickBooks Online. You're going to add expenses, you're going to add your income, and then you're going to transfer. So the transfer is another functionality within that banking section of QuickBooks that allows you to transfer funds from one asset or one asset account to a liability account or a liability to an asset, whichever way you want it to go. But transfers are basically a way to not duplicate transactions. So for example, if you add a credit card payment to the credit card and you add a credit card payment in the checking account, you're going to have duplicate transactions in there. When you transfer funds from that checking account to the credit card, that functionality is going to move funds from one to the other within QuickBooks and not allow you to duplicate that amount. So that's really when and why you would want to use a transfer, is to transfer between balance sheet type accounts. A match is another functionality that you want to use in the event that you're using deposits, invoices, payment receipts, or sales receipts. So all that sales function side within QuickBooks that we're not going to get into today because it's too complicated right now. But you want to make sure that you are matching to those transactions. If you do not match and you have created let's say you've created a deposit for $500 and you say that deposit is going into your checking account. In the banking feed, when that deposit actually comes through your bank, you should see that $500 deposit in the banking feed. You want to match to that so that you're not duplicating or overstating that $500 of income. All right, choosing the right category. And by this, I mean selecting the right account to put a transaction to. Really the best thing we can say here is to do your best. It's not a make or break decision. If you choose the wrong one, it's not going to ruin your books. Your CPA is not going to yell at you, I promise. They're going to really be happy that you're just doing your bookkeeping. But if make sure that you're picking an expense account, you can and toggle through that and pick the most fitting expense account. For example, expenses to Write Capital and e-money, maybe you do want to put to software and technology, where expenses to XYPN for your dues would go to dues and memberships. You can select the most fitting correct account. And really the point here is to be consistent with what you're doing so that you can use that for comparative analysis functions in the future. All right, next part here, manually enter non-connected accounts. Really what we're talking about here is TD Ameritrade sundry accounts, because many of you who do investment management and custody at TD will have that sundry account. That, as I mentioned before, does not connect to QuickBooks Online, so you'll have to manually enter that data. Sometimes you can download a CSV file from TD Ameritrade and import that into QuickBooks and then code it that way, or other times you'll have to look at that statement and manually enter that into the register. You want to make sure you're doing that, just because if it doesn't get done, it could mean that your income is not being recorded correctly on the date in which it's received. Many times you can sweep your money directly from that TD Ameritrade account to your checking account as soon as it hits, and you can record income that way. But in the event that you do not do that, there's often a balance left in that TD Ameritrade account. You want that to show up as an asset on your books, so it's not sort of just lingering in thin air somewhere. If it's owned by the business and it's an asset account that you have control of, it should show up on your books. All right, let's see here. Next step is reconcile. So the best tip here is use that QuickBooks reconciliation function. You don't need to go through your checkbook anymore and balance your check register. That's basically what reconciling does. A reconciliation is used to verify that the balance on the bank statement matches the balance sheet as of a given date. This will turn up any missing or duplicate transactions, as well as show any uncleared checks that have been written but not cashed yet. You can go to this directly from the navigation bar on the left side of QuickBooks. It's really easy to see. Once it's balanced, it's like shows this big green check mark with a $0 button. All you do is click finish, and then you've done the reconciliation. It's very simple. When it is not simple and when it will cause you a lot of headaches and time is when it does not balance, and that's when you're going to want to be calling us probably. No, kidding aside, but the reconciliation function is very powerful. It can really show you anything mistake-wise that is happening in your books. All right, next step that we recommend you do is review the profit and loss, or the income statement, as many of you may call that. You want to ensure for consistency. So really just making sure that every transaction is categorized the same way for each vendor, verifying for that consistency amongst prior period transactions as well as the current period, just to ensure that everything's correct. You also want to make sure that recurring expenses, so those expenses that you pay every month for, so the monthly dues or monthly expenses, are categorized the same way each month, so you can have that comparative analysis. You're going to want to review any uncategorized income and expense accounts. So say, for example, you have a mobile deposit and you don't know which client that's necessarily associated with. You can dump it into that uncategorized income account just to review it at a later point in time when you're in that checking account, looking back at those mobile deposits or trying to look at your checks and see what happened. Same thing with expenses. If you don't know how something should be categorized, or if we don't know how something should be categorized, we're putting it to the uncategorized expense account so we can reach out and get some further clarity on that from you as our client, or to look out on Google or look at our other resources to ensure we categorize that correctly. Other things for the reviewing the profit and loss that I don't have on here is just to make sure that every transaction has a vendor. You always want to make sure that every transaction you enter for expense purposes mainly has a vendor name associated with it. You don't want to have transactions with no vendor name on there. We'll talk about 1099s here in a second, but that is really why. Finally, review that balance sheet. You've done the reconciliation, so you know that the transactions that are going into that reconciliation are balancing to that bank statement that you put in there as of a given date. But basically just take a look at that balance sheet and make sure that what's showing up on the balance sheet as of the end of the month matches that bank statement. There are instances, like I talked about previously, when a check hasn't cleared yet, but it's in the banking feed and it will show up and sort of make that balance different. Basically, you want to just understand why that may be happening. Second part here is look into any negative balances. Negative balances are not typical of a balance sheet. So if you have a negative accounts receivable or a negative asset type account, that's probably going to be incorrect. Unless, of course, it's accumulated depreciation or accumulated amortization. Those are basically offset accounts for asset accounts, fixed asset accounts. But any negative balances in the liabilities are also going to be incorrect too. That would potentially mean that you're overpaying for a liability. Usually that means a mistake has happened. You want to just make sure you're getting it fixed. Negative balances aren't typically. Uncategorized assets, much like uncategorized income and expense accounts, this is a temporary holding account. If you're transferring funds from a line of credit to your checking account, you don't know which checking account to put it to, you could temporarily put it in that uncategorized asset account until you know exactly where you want to put it. And I did briefly touch on this, but verify that the liability accounts are zeroing out, that they're not negative, and they aren't building a balance over time. A good example of this is if you are incurring a bunch of, say, your startup expenses on your credit card, and you aren't paying that credit card, that balance would keep building and building and building on that balance sheet. You just want to make sure that it is actually getting paid off, and you can see that by looking at that register for that account and making sure that payments are being applied to it. You want it to be indicative of what's actually happening at that credit card company. You want the balance to match. Next part here, other considerations. So meals and entertainment, you want to make sure that you are recording those correctly first off. They're not this year, but in prior years and probably in future years, there's different ways that you deduct meals and entertainment. Typically it's 50% for client meals or travel meals, but if you're having an employee meal or an employee party or an event, 100% of that meal is deductible. So just make sure that you're delineating between those two when doing your own bookkeeping so you can get the appropriate amount of that deduction, whether it's 50 or 100%. Grossing up payroll, this is a little bit higher level than 101 here, so I'll just touch on it briefly. But when you pay a payroll company, you are basically paying them the net amount of all the wages that you paid, of all the taxes that you're paying, of all the benefits. So grossing it up means that you're taking that net amount and figuring out how much employee one earned, how much employee two earned, and putting that to separate line items on that transaction amount. You're also going to move any of the liabilities for payroll liabilities over to the balance sheet by doing that gross up. Grossing up income, this is, I'm strictly going to reference advice pay here because advice pay, for those of you that don't know what advice pay is, it's a compliant payment processing system. But basically advice pay, when you charge a client $200 and invoice them through advice pay and the payment is collected there, when you transfer those funds to your checking account, the amount you're receiving is not $200. But when you are recording that income to record it correct on your books, you should be recording $200 of income. So basically you need to split that transaction, in turn grossing up the amount of the deposit to $200 and record a $2 bank processing fee or merchant deposit fee or whatever you want to call that. Just make sure that you're appropriately reporting the correct amount of income and you're not going to have an underreporting issue for that income. Next thing I have here is adding to the chart of accounts, what's appropriate and what's not. Really, we've seen a lot of advisors come to us with their chart of accounts in their book that they've been doing. And they'll have a different account on the chart of accounts under software and technology for every vendor that they're paying for that tech. So they'll have Right Capital, they'll have eMoney, they'll have you name it, it's in there. That is not a best practice when doing your own bookkeeping. There is a way to see how much you're spending with each vendor by just doing a quick vendor report. Really the goal of having a clean chart of accounts is to have a clean profit and loss that you can easily see, easily read. It's not confusing, it's not overwhelming, and you can easily translate it into a tax return. So don't be adding chart of accounts with vendor names, please. You can add chart of accounts to have a little bit more detail. So say you have advertising and marketing. A good one to have would be lead generation or marketing and advertising as sub-items of that account. So you have a little bit more detail, yet you can still put the entire amount of that advertising and marketing directly to the tax return. You know what your total advertising and marketing spend is and use it for budgeting. Next one we have here is loans, principal versus interest split. Much like your mortgage, you have principal and interest for those payments. Same thing as if you have a business loan, you're likely going to have a principal and interest amount in there. And we just want you to be aware of that so that when you see those loan payments going out, you know that you need to split that transaction. There is a split functionality, and we have a good blog on this, split function in QuickBooks banking feed, so you can just easily split the amount of that payment to principal versus interest. Something you should be aware of if you have loans or if you're paying for a family plan of your cell phone, you want to put 50% of it to the business and 50% to owner distribution, you can also split it that way. 1099s here, I briefly alluded to this before, but every transaction needs to have a vendor name because you may have to send them a 1099. We also have a good freebie, I believe, on our website, or we may send this out around 1099 season, that basically shows you, walks you through a process to tell you whether or not you should send a vendor a 1099. Think about it as if you pay someone more than $600, that's one thing to look out for. If you paid them with cash, check, or ACH, that's the second criteria to look out for. The third one is if they are not incorporated. So if they're a sole proprietor or a single member LLC, you likely have a 1099 filing requirement for that vendor. The IRS, when you're filing your tax return, has a little checkbox for that Schedule C and the 1065 partnership return and S Corp 1120S return that says, yes, I filed the appropriate 1099s. If you check that box, that's basically saying that you did file those, so make sure you do it. Cash versus accrual. So I talked briefly about this before, but each state has a requirement for this. Many of the states that we see, specifically California, has an accrual requirement. What that means is if you bill for quarterly investment management fees and you're billing for that in advance, you receive all that money up front on a cash basis. On an accrual basis, you haven't earned that money yet, though, until the period in which it's been earned at the end of that month. So say, for example, you bill on October 1st for Q4 of 2021. You receive $1,200, and that on a cash basis goes directly to your income statement. But if you're in California on an accrual basis, they want to see that income appropriated to the period in which it is actually earned. So on October 31st, you would have earned $400 or 1/3 of that quarterly income. Same thing on November 30th and December 31st. So that's the difference between a cash and accrual. Accrual is a recognizing revenue or recognizing expenses in the period in which they are earned or incurred, where cash is literally just when that money hits your account. There's a lot more to that, and I believe I will be talking and presenting about that during XYPN Live, so make sure to sign up for that Coach's Corner there. Receipt management. Basically here, all we say is to do something and do it consistently. Your bookkeeper and you don't necessarily need to look at every receipt you have, but really you need to maintain a copy of every receipt in the event you go through an IRS audit. They're going to want to see receipts for specifically meals and entertainment and travel expenses, just to make sure that you are correctly recording those and not really sliding them, but making sure that you have substantiation for those expenses that you are deducting is paramount there with the receipt management. Last but not least here, I believe we have tips and tricks. All right, so banking rules. This is a functionality within QuickBooks that we wrote a good blog on recently too. It's on our website, xybeancounters.com. But basically a rule can look at a transaction and find certain criteria that the bank puts in that banking feed and apply that rule. So it can put it to a certain expense account, it can put it to a certain income account, it can really do anything that you tell it to. You can have it look based on the amount, if the amount is going to be recurring, or certain criteria within that. And really what this does is it takes any thinking or looking up to know where it should go. It's basically applying a rule and coding it to a certain area, and all you have to do is accept it. You can even auto add it within QuickBooks. Really, this takes a lot of the time away from the bookkeeping function, like that first part of it, the categorizing transactions, and it automates it. So I really recommend you do this and spend the time up front to do this, because I guarantee it will save you a lot of time down the road. Splitting transactions. We talked about this a little bit previously, but for example, that cell phone bill where you have a personal portion on a family plan and then you have your business portion. You would probably want to split that, and you can do that within QuickBooks, but you can even do it within a rule. So you can split it 50-50, you can split it 60-40, or you can say $100 of the $250 amount is for the business. You can do it any way you want, but make sure you set that up and use that effectively, because it will sort of eliminate that headache later on when you go file your taxes and your CPA says, what portion of your utilities are business purpose versus what is personal? You can just do it automatically, so there is no question there. Month-end review, just make sure you do it. That's what we talked about in step 4, reviewing that balance sheet, reviewing that profit and loss, making sure things look correct. If they look correct, you're probably good. Make sure there's no negative liabilities, negative assets, and liabilities are actually zeroing out, not just building. Another good tip here is building a regular bookkeeping habit. Whether you want to set it at the last day of the month on Friday at 4 o'clock and have a beer while you're doing bookkeeping, just having something consistent and making sure you maintain that is the best practice here. If it happens where you go 6, 8, 12 months out and don't do your bookkeeping, and you happen to get told that you need to send financials to your regulator for a sort of a surprise audit, it's going to be a lot of work for you to get caught back up and make sure that is done. So just try to stay on top of your bookkeeping if you're doing it yourself. If you also find that you're not doing your bookkeeping, you just can't find the time to do it, even if you set the time aside on your calendar, think about outsourcing that. It's probably worth it, worth the peace of mind knowing that it's getting done, so you don't have to scramble when that audit happens. Another quick tip here is duplicating tabs on your browser. In QuickBooks Online, you can have infinite number of tabs open, and it makes it really easy when you're doing multiple functions within QuickBooks. Say, for example, you're looking at a prior period vendor or prior period report, and you also want to have the banking area open. You can duplicate tabs by right-clicking and then click duplicate tab and have multiple tabs open that you are working in simultaneously. Recurring transactions. So this is only in the Essentials Plus and Advanced versions of QuickBooks, but basically recurring transactions allow you to make invoices on a recurring basis. You can have it automate. So say this is really good for a retainer type model where you're billing a client on the first of the month, every month for as long as they're a client. You can set that up one time in QuickBooks, have it happen on the first of the month, and it'll take care of the rest. Accountant settings, this is really just making sure you add all this basic business information when setting up your account, like where you're located, what state you're in, what entity type you are, phone number, address, all that good stuff. Just make sure that's all in there. And also it allows you to have the appropriate information when you're invoicing clients and they see your information on there. Last tip there is subscribe to our blog. We put out a lot of good content there, not only on quick tips on QuickBooks, but also accounting in general. Things to avoid, I'm really going to go through this relatively quickly, but mixing personal and business, just keep those separate. You're starting a separate entity that is separate from your personal self, and you want to just maintain that separation. Don't mix personal and business. Having too many bank accounts. We see this often where someone's trying to, not necessarily bank accounts, but credit card accounts, where really trying to maximize those points. The more accounts you have, the more opportunity there is for error and mistakes. Keep it simple at first until you really know what you're doing, then you can add more bank accounts. Always add transactions with a vendor or a payee name. Really that ties into the 1099 purpose there, and looking back and seeing how much you spend at a particular vendor. Don't change the transaction amounts after reconciliations have happened. Reconciliations are really verifying that that amount that is in there is correct. And therefore, if you change it after the fact, that reconciliation is really null and void at that point. It's kind of irrelevant. So don't change transaction amounts after you have done that reconciliation. If you do have to go back and do that, you're going to have to redo that reconciliation. Not the end of the world, but just make sure you do that. Deleting accidental transactions. So we see this often where an advisor says, hey, I paid for dinner with my family on my business card accidentally. Can you delete it from my books? No, you can't delete that from your books because it went through that business account. What you really need to do is just code it to distribution or member distribution, member draw account. Just don't put it to the profit and loss so it's not deducted. It's just as if you took money out of the business to pay for that meal personally. All right, the last one here is sending cash-based financials to your state that requires accrual-based financials. We've seen this happen, and the regulator instantly sends it back, and it basically opens you up for more scrutiny, looking into your books more. But basically, if your state says you have to send GAAP-based financials or accrual-based financials, make sure that little toggle button on the top of QuickBooks says accrual, not cash. That will say cash-based financials on the bottom when you actually print that to PDF. Last tip there, or thing to avoid there. All right, so finally, why outsource? Most of our advisors didn't really launch their practice to do bookkeeping. You all probably want to spend time working with your clients directly, helping them live their great lives, and really freeing up that time or having the time to work with your clients as much as you can and focusing on the things that you want to do. If bookkeeping is something that you enjoy doing and you like it, by all means, do it yourself, don't outsource it. But by outsourcing, you can free up that limited time that you are going to eventually have to focus on what you want to do most, which we are guessing is being that entrepreneur, working with your clients, developing financial plans, investment management. So get your time back. By outsourcing, it allows you to manage the books rather than doing the books. So you're focusing on what's important. Big picture, how's the P&L look? Can you use it for analysis? Can you build projections and budgets and forecasts off of that and use that accurate profit and loss and balance sheet to do that? And is that a better use of your time than actually preparing it? So the value there is really seeing, being able to use the books rather than do the books. Peace of mind, this ties into how we are experts in this industry. So knowing that it's getting done is one thing, but knowing that it's getting done correctly in accordance with state regulators and SEC want to see. So that's really peace of mind, knowing that you have a knowledgeable team behind the scenes doing the books for you accurately. So the final part here is access to a bookkeeper and a team who knows your industry. We really do spend a lot of time working with our compliance department here at XYPN. We spend a lot of time working with our clients and looking at deficiency notices to really build a better practice and build a better business that focuses just on this industry. Are really doing a good job understanding the nuances that apply to you to make sure that you don't get these deficiency notices. So access to that bookkeeper and the team, you can ask questions of them and sort of peace of mind knowing that we are here for you. Last part here that I didn't talk about is what is your hourly time worth? And we actually have a poll on this for the last poll of the day. But if you can get an hour of your time by not doing bookkeeping, you will likely generate or pay your books. So let's see if that is true based on the hourly rates here in this next poll. All right, last one here. We'll give it about 30 seconds, then we'll open it to review that and do some Q&A. All right, 175 to 250 an hour. Not sure, so I prefer not to answer. We have a few more votes in here. All right, we've got 16. All right, overwhelmingly, 50% of you, $175 to $250 an hour. If that is what your time is worth, and you can take that hour to develop that much money, you can basically spend anywhere from $50 to $100 an hour on a bookkeeper and free up that time so you can generate that. Basically come out ahead on that. So that's really showing the value prop of your time, what it's worth, maybe what it costs to get your bookkeeping outsourced. All right, thank you all for doing that poll. I appreciate it. I'm gonna go ahead and close that now. So that wraps up the presentation on Bookkeeping 101 for independent financial advisors. So I think I'm going to stop sharing my screen here and we will open up for Q&A.
Perfect. Thanks, Dan. That was so interesting and informative. So the first one that I've got for you is XYPN counters only available as an XYPN member.
No, we do work with non-XYPN members on bookkeeping services. So we are happy to work with you as long as you are in this industry that we focus on, which is the RIA or independent RIA, or even in the broker-dealer financial planning industry.
Great. Mm-hmm. And then, so if you're just launching an RIA and you're in a state that requires a balance sheet, are regulators going to look at your personal balance sheet if you don't have an entity one yet?
I am not sure if they're going to look at your personal balance sheet, because I think even if you don't have an entity balance sheet or there's no balances in that entity balance sheet, you can still file and say you have $0. But in a state that requires you to have a net worth of $10,000, for example, they're going to want to see that that entity has the net worth of $10,000. So you'll have to start that entity. You'll have to contribute the $10,000. Make sure you meet that net worth requirement when you're getting registered initially.
Gotcha. And our compliance team will definitely walk you through that.
Exactly.
When should furniture or computer equipment be expensed versus depreciated?
I am a big proponent of expensing when you can and not depreciating. The main reason is depreciation takes time from your CPA to develop those depreciation schedules and make sure that everything is depreciated correctly. So if it is less than the de minimis safe harbor amount, which is $2,500, I believe, you can expense it automatically in that given year. The only time when you would probably not want to do that is if it's for tax planning or tax savings purposes, where you want to save some of that depreciation for future years when you know you're going to have more income. But for the most part, it's much more simple to expense when you can. You don't have to have depreciation recapture. You don't have to deal with depreciation with your CPA, and basically your CPA is going to bill you hourly for figuring all that out. So it's going to cost you less in the long run to expense when you can.
Good to know. Then how should credit card cashback or statement credits be categorized?
I like to do that as other income type account on the books. That way it's still showing up on the books because you can't just exclude it, otherwise it won't balance. But it's also not showing up as your firm or your high level revenue income. It'll show up as other income, so your CPA can see it separately. There are different, I don't know exactly the tax code on this for every type, but there are different ways that CPAs categorize that, whether it's non-taxable or taxable benefit. Having it separate from your generic revenue is the best practice there, so they can see exactly what it is though.
Gotcha. Great. And can you attach a receipt to transactions in QuickBooks?
You can. Okay, you can drag and drop, add it as an attachment to each transaction.
Great. Let's see. I had another one. It isn't easy in QuickBooks to accept an upfront deposit from a client and account for that properly. Any tips?
I would have to know more. So whoever that is, email me, dan@xyplannetwork.com, and I can help you look at it, because I don't agree with you that it isn't easy. The only time where it might be difficult is if you don't have invoices set up correctly or sales receipts set up correctly. But if you're not doing any of that in QuickBooks, you can just record it as a deposit directly to that profit and loss. I may not be understanding the question correctly too, so please email me.
We can put it in the chat. Let's see. So should I be paying my health insurance through my business?
That is a good question. So that's a really good one for your CPA, to be honest, but I can sort of take a stab at it. I'm not a CPA, so I'm not giving tax advice, by the way. But you can pay for it through your business, but if you are a single member LLC where it's not a benefit of your business, it cannot be deducted by the business, meaning it has to be recorded as a distribution or a draw. In this instance where you're doing this, I recommend you have a sub account of owner distributions or owner draw called health insurance draw or retirement benefit or owner distribution retirement, just so that your CPA can see those items separately in there and know what to do with it. Basically, when you're, as a single member LLC, you're filing Form 1040 Schedule C. That health insurance benefit for yourself is not an expense of the business, but it can be deducted as an adjustment to income. For any of you that know about taxes, it's basically below that income line on there. As an S Corp, if you're paying for, as an S Corp, you have to pay yourself a salary. You can have part of that benefit of being that S Corp owner be health insurance that the business pays for. It does have to go into your W-2. In that case, it would not be going through the balance sheet. It would be going through that expense account. And we recommend you have that as a sub account of owner's compensation. S Corp owner health insurance benefit is what we call that typically. So make sure it's set up that way and record it in there.
Great. So kind of along that same line then, should we be paying utilities that are split with personal expenses like the internet through the business account?
You certainly can. And the question there is, if you are not paying them through the business account, are you going to remember to put them on your taxes at the end of the year? That's up to you to decide if you're going to remember that or not. But if you do put them through the business account, use that split functionality that I talked about previously. Sort of figure out how much of that utility should be business purpose, how much of it should be personal. Split it so that 50%, if that's the number, goes to the profit and loss under utility expense. The remaining 50% goes out as owner distribution.
Would a regulator question how you came up with that split, or is that really up to your discretion?
I don't know if a regulator would request that, but an auditor would. Your CPA should question you on that too if they're helping you with your taxes. Like, say, is this like how did you figure this out? What sort of did you look at to figure out this number?
Perfect. Can you do trust accounting for family or private trust structures?
We have not before, so I'm not sure what all that might entail, but we could take a look at it and see.
Okay, very helpful. Let's see. So are there some tax deductions that advisors frequently forget to track?
So the biggest ones are when I talked about the expenses that you incurred before you had your business checking account set up and you're paying for business expenses on your personal accounts. Oftentimes those sort of get put to the wayside. You're thinking of all these other things that you need to do to get your business started up. You need to get your accounting system set up, and maybe you don't do it right off the bat. Those are oftentimes the ones that we see most often forgotten. So if you paid for rent for a few months on your personal account, or you paid for your XYPN dues on a personal account until you had that transferred over to your new business account, those are the ones that we're seeing get forgotten. So make sure you document those on Excel, get those imported into the books as owner contributions so you can deduct those.
Awesome. And how would you handle home office expenses and utilities now that everyone's working from home a bit more?
So home office expenses is really a tax adjustment. Like, you can say that your business is paying you personally, I don't know, $100 a month, whatever it is, to use the home office. But really a home office expense isn't a cash expense of your business, meaning you're not paying rent for your home, you're not paying utilities for your home out of your business necessarily, but that's done when you file your taxes. And there's a couple ways to do this in your taxes that you can work with your CPA on, or our CPA team here at XY Tax Solutions. But basically you can do the simplified method, and it's, you take $5 per square foot up to, I forget what the total amount of square footage is, but it's a simplified method. The thing here is the office has to be used exclusively and solely for business purpose. It can't be like a spare bedroom that your kids stay in and you also have a desk in there. They would not call that a home office, so it has to be completely separate. The other way is I guess it's the standard method, non-simple method, but you're basically tracking expenses for the entire house. Say you have your mortgage payment, so you have your principal and interest, you have utilities, internet, I guess internet falls in utilities, but renovation expenses for that office. You're allocating it to that office space based on the percentage of square footage that that office takes in the house. So say it's 20% of the square footage of your house, you would take 20% of those rent expenses and utility expenses to as a home office expense deduction on your tax return. Again, that's done when you're filing taxes. It's not necessarily done in your books as a bookkeeping function.
Great, very helpful. So I got one last one for you. If I were to outsource the accounting function, what should I expect to pay for the setup and ongoing services?
So setup, if you were to work with us, depending on whether you're an XYPN member or not, there is a different price rate for that, for the ongoing bookkeeping and the setup and training. So setup starts at $197 if you are an XYPN member. That's basically gets your account set up, uploads our chart of accounts template, connects your bank accounts, and shows you what you should be doing for the bookkeeping. If you decide to outsource the bookkeeping to us as an XYPN member, that starts at $89 a month, and it goes up based on complexity, amount of gross revenue you generate, volume of transactions you have on a monthly basis, and number of accounts that we are reconciling on a monthly basis. Our pricing structure can also be seen on our website, which is xybncounters.com.
Great. I think we'll put that in the chat too. Well, we are close to the top of the hour, so I do want to mention that if you are interested in having a conversation with me or another of the XYPN sales team, please follow the link in the chat to find a time that works for you. Also, when you click back to the lobby, you will see a feedback survey that will pop up when you leave the webinar. Please, please, please take a moment to complete that. We would love to hear what you thought about today's content. So that's it for us. I hope that everyone has a great rest of your day. Thank you so much for joining us. Bye, everyone.
Thank you. Bye.